Good morning and welcome to the Asset Preservation Hour. My name is Cynthia DeFazio and I'm joined today by Stewart Willis. Stewart is Managing Partner of Asset Preservation Tax and Retirement Services. Good morning, Stewart. How are you?
Having a phenomenal day. How are you doing?
I'm having a phenomenal day too, and I'm so excited about our show today because there's been so many topics surrounding retirement right now. But I'd love to just ask you, Stewart, where does your passion come from first and foremost for helping others? Because I know that you feel very strongly about people being prepared for the retirement years, and so often people are not. So where does that drive come from? What is your why?
Well, first and foremost, what really fires me up is when I see people out there with tons of bad advice. It kills me. I'm very protective over the financial industry. It's really important to me to make sure that people are getting good advice. Teachers and municipal workers in particular, we're seeing just some horrendous advice out there, and I don't like seeing that. And I think that it's really important for people to be properly informed. And it's like forks in a road. The differences between a well-planned out retirement and something that's really poorly done can just dramatically change the impact of retirement, the enjoyment of retirement.
Sure. I mean, I would kind of equate that to maybe someone who's trying to build a house without an architect.
Yeah, for sure.
Truly, because then it just actually wouldn't work out. And so it's so important to have that proper guidance. Can I ask you, a lot of times the bad advice, so to speak, is that coming from people that are like colleagues, people that are coworkers, or, Uncle Joe?
That's a great question. I mean, quite honestly, there is a lot of, a lot of instances where clients of ours or potential clients come in and they say, look, my buddy said that you need to buy this, you need to buy gold, or, you need to buy this stock. And the first thing I think people should do is really think about stopping the water cooler talk when it comes to financial advice. We have a couple offices in the Phoenix area, one on the West Valley, Sun City area, and another in Scottsdale. And what we see at one of the locations in Sun City is there's a country club, and I won't name its name, but all of these golfers, we've got tons of clients who are golfers.
Yep, absolutely.
And what we see is these guys are having a few drinks when they're golfing and telling their buddies about their returns, and honestly, they exaggerate. And the reality is that they don't understand the impact, because oftentimes that advice they give, these people are taking to heart. And sometimes they try to implement it. And it's a really hard conversation for me when they say, hey, you know what, Joe's telling me, he recommended you, and he's telling me to buy this and this and this. And I realize that Joe doesn't actually own those things, or he's not doing that strategy. So, even the well-intended, great clients of ours and, great people out there, sometimes they're just jibber jabbering, and I would say turn off that noise. Learn to filter that out and find an advisor that you really trust, that you really like. And going back to your original question of what drives me, what is my why? Well, the reality is, professionally, it's really easy for me to do what I do because I don't do business with people I don't like. And I think clients should feel the same way about their advisor, right?
Yeah.
We don't see a lot of turnover in our business. Our clients are long-term. When they come, most of them, never even consider leaving, because we filter that out up front. I even say to our clients, if you're not comfortable, find someone you're comfortable with.
Sure.
Because we don't want to be switching, constantly.
Sure. And it's amazing, we hear so often that I know that clients that have maybe worked with someone before coming to your firm, they'll say that the problem was they never had communication. So often maybe people are with a big box, if you will, and they're not hearing from their advisor. So Stewart, how important is communication?
Well, first and foremost, in this post-COVID world, things have changed a lot in terms of communication, and quite honestly, for the better. We've employed some technologies that allow us to video conference, like Zoom. We also have video messaging, so I'll send video messages to our clients, when there's things that I want to communicate that, sometimes things get lost in translation when you're typing an email. Half of our clients are comfortable coming into the office. this, the other half aren't. And so technology has really changed the way that we do things. I mean, we're known for the parties that we have at our office at Christmas. And you have to understand, the parties aren't about having a party. The parties are about creating an excuse to have a conversation with our clients about what's going on in their lives.
Yeah.
And so it's really important to have that communication, which is everything. Because as things change in your life, it's really important that translate into change in your plan. Because oftentimes, you know, if you know, somebody in your family passes away, the estate plan needs to change, you know, or your tax plan is changing, right? So it's really important to make sure you communicate and adapt to any sort of future changes.
Absolutely. And Stewart, I love how you mentioned having it be important to work with someone that you trust. So I definitely want to talk about you being a fiduciary. To the viewing audience at home, they may be semi-familiar with that term, but can you explain what that is and why it's a benefit to them?
Yeah, and it's interesting because there's two distinct ways that the word fiduciary is used. There is the fiduciary standard, which just means you're putting the client's position above your own. And then there is a fiduciary, which is an advisor that is completely conflict free, that any sort of conflicts that do exist must be disclosed. So if you were to compare a fiduciary to like a broker, you know, a lot of the big box shops are brokerage houses. And they are, their allegiance is to their firm first, to the client second. When it comes to fiduciaries, understand my license prohibits me from receiving any sort of back-end compensation from mutual funds and so forth. So any sort of securities, you know, transactions, it doesn't do us any good to have you in an expensive position because, first of all, we don't get any of it. So if I can find something that's 1% in cost versus 0.14, well, I'm going to go for the 0.14 if they do the same thing. Whereas oftentimes those more expensive mutual funds that are part of your standard portfolios at big box, you know, brokerage houses, there's usually a relationship on the back end where the company's getting compensated for, you know, doing that sort of business with those specific funds.
Okay, and I think a lot of people may not even realize that when they're coming in, maybe they hear from their advisor like, well, we've got to actually get this for you, this is perfect. It's not necessarily to benefit the client per se, but sometimes there's a commission that's earned.
Yeah, commission or just back-end fees that you know aren't discussed. And quite honestly, you need to understand how your advisor gets paid, or anybody, whether it's a financial advisor or anybody else. I always say you need to understand how somebody gets paid in order to understand their motivations, right? So sometimes you get guided in a direction that, you know, the guy sounds like a nice guy, but it may not actually be in your best interest. It's really to kind of, you know, inflate the commissions or the fees on the back end. And when we do these in-depth portfolio analysis, we tear all of that apart and we show it to, you know, our prospects and our prospective clients how many fees they're paying, the dollar amounts, what the expenses are, any sort of conflicts, and actually how the whole portfolio works together. It's a really important thing to look at those expenses.
Excellent. Well, Stewart, we're about ready to open up the phone lines for the very first time today. Can you tell the viewing audience what they can expect to receive by being one of the first 10 callers? Well,
the first 10 callers will receive a complimentary portfolio analysis. We will take a look at all those fees I just talked about. We'll take a look at the internal costs of the mutual funds. We'll look at the fee structure that you're paying to any advisors. We'll also take a look at how all of those funds work together.
Okay. Thank you, Stewart.
No problem.
Well, to the viewing audience at home, the phone lines are officially open. That number to call once again is 833-652-7829. When we come back from this very short commercial break, we're going to have more questions and answers about planning your perfect retirement. So please stay tuned.
What happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old. They've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement knowing that they're not going to run out, that they're going to be fine. You know, I think it brings a smile to their face.
we get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. Keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, you know what, 5 years, 3 years, tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning. We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes? It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He is Managing Partner of Asset Preservation Tax and Retirement Services. Stewart, a great first segment to the show.
Thanks.
And so important to talk about the benefits of working with a fiduciary, which you most definitely are, and I love that. The question I have is, let's say our viewers right now are at home and they're having a cup of coffee and they're looking at each other and they're having casual conversation about where their life is heading. How does someone know that they're ready to retire? What should they be doing right now to kind of determine that?
Well, first of all, we had a client that came in the other day, and he's 83 years old. Okay. And he still is literally, and he has substantial amount of savings. But what we find most of all is people just have this huge fear that they're going to run out of money later on in life. And the reason I use this example of the 83-year-old is, he comes in, he's saved his whole life. He's got this big pile of money, but he's not enjoying it because he's so worried about the end of, his life being without. And so for those clients that become financial clients, we do some really in-depth cash flow analysis to kind of show you whether or not you'll be fine. And what we're finding oftentimes is people will be fine so long as they don't mess it up, right? If they've done a good job of saving all their lives, it's about having a plan, about knowing what's going to happen. How much rate of return do you need to be successful over time? And so we have some of the most sophisticated cash flow software available, and it's really important to do that work to make sure that oftentimes we see clients that'll come in and they say, look, I'm 62 years old, I'm going to take Social Security, and I want to retire. Well, what they're not thinking about is healthcare costs, right? Sure. Medicare doesn't start until 65, and quite honestly, that is a huge, huge cost.
Oh yeah, absolutely.
There's other clients of ours that spend very little of their retirement funds in those years before 65 to get access to access. Sure. Access to access. That sounded funny, but it's a program here in Arizona that allows people that have lower income to have access to healthcare at an extremely discounted rate. And that may or may not be the right option for people, but it's super important to make sure that you take into consideration all the costs before you retire. Sure. By taking Social Security at 62 versus 66 or later, what are you giving up? And I think there's no right or wrong decision so long as you're making an informed decision. And I think that oftentimes people wing it, Sure. Staying at work at 62 is a lot easier than trying to go back at 66.
Absolutely.
Or 68, right? When you realize, oh my gosh, I'm running out of money. And so I think it's really important to have a plan, to really understand what the impact is going to be if something happens, or if you run out of money.
Absolutely. Stewart, let me ask you, because you obviously have mentioned portfolio, how important is it to have that rebalance? How often do you recommend that?
Well, so typically rebalancing is a lot of firms quarterly rebalance. We're a little different. We use some of the best money managers in the world, in my opinion, and almost all of them are tactical. The difference between tactical and passive is that the passive money managers will rebalance quarterly, just, maybe you have a 60-40 bond split, stocks and bond split, and they just want to keep those numbers in those proportions.
Okay.
Tactical is a little different, where they're looking for opportunity. So we have one of the money managers we deal with internally that believes that there are 6 different distinguished parts of the business cycle. And in each of those stages, that there's a particular set of investment that does well in each of those.
Okay.
And so if the markets change, if we're in a recession, that looks like a completely different portfolio to some of our underlying investments than if we're in expansion, right? We're in completely opposite. So our strategies generally revolve around, not trying to beat the markets on the way up, but trying to not lose on the way down.
Sure.
And so a lot of what we're seeing from people right now is they're just concerned about losing, right? They know that we've had this amazing bull market. I think the COVID drop really kind of awakened all of these, sleeping, people that just basically realized, oh my gosh, I could lose 30%, right?
Yeah.
And so I think it's really important to have a strategy that's meant to also preserve some of it, whether you're in equities or fixed investments or whatever, but just to make sure that some of it's protected. And I think that's what we do really well.
Stuart, let me ask you, what does it feel like for someone to be a client of yours? What is that experience like? What can they expect?
Well, I think we are not meant for everybody, and that's okay. But we want communication. We don't want 10,000 relationships with clients on a surface level. We want to have a deeper relationship. And what I mean by that is not to get into your personal life, any of that, but just to make sure we understand what's really happening at all levels in your financial life.
Sure.
So if, we have a client that comes in and says, hey, Stewart, do I refinance? And we will work out all the math for them on whether or not it makes sense, right? Because refinancing always sounds good. We're at the lowest interest rates in history right now.
We are, yes.
Right? Does it make sense? Does it not? Well, if you've got 2 years left on your mortgage, refinancing it into a 15-year if you don't need to really may not make any sense. You may pay more fees than it's worth. Sometimes paying a higher rate short term is better than paying a low rate for long term and paying all the additional fees. So once again, there's no right or wrong, just so long as you understand the implications. And what we do really well when it comes to the relationship with our clients is we tell them exactly what our perspective is on things. We're looking for the full relationships. We don't, we are very high touch, when it comes to our clients, when it comes to other parts of their lives. We want to make sure that clients have their estate planning done. It's one of the things we do. We've had a 15-year relationship with the same attorney that sets up our estate plans for our clients. And it's super important. I jokingly tell my clients, because we don't make money on the estate planning side of our business, I just tell people I don't want to hang out in probate court with your kids, right? So I just want to get it done. Like, I jokingly say I'm a man of leisure, and I don't want to deal with, but it's really, let's get things in order.
Yeah.
Financial side, the estate planning side, tax side, etc.
Absolutely. Well, Stewart, it's time for us to open up those phone lines one more time to the viewing audience. Can you tell them what they can expect to receive by calling in today?
Sure. Well, once again, we're going to offer to the first 10 callers a complete portfolio review at no cost. We'll also take a look at any sort of tax implications or questions you have. All you have to do is call 1-833-652-7829. We'd be glad to help.
Stewart, thank you so much. To the viewing audience at home, it is time for us to take a short commercial break. That number to call once again is 833-652-7829. When we come back from this short commercial break, we're going to have more questions and answers about planning your perfect, stress-free retirement. Please stay tuned.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He is Managing Partner of Asset Preservation Tax and Retirement Services. Stewart, a great show that we're having today. I think one of the most important questions I want to ask, if someone in the viewing audience right now is maybe 10 years away from retirement, what should they be thinking about?
Well, first and foremost, I think, swinging for the fences like a lot of people do with their, investments early on, where they're taking extreme amounts of risk, they really need to look at whether that makes sense anymore in their situation. What we see oftentimes is when people have their kids that are living with them, before college or whatever, it's a lot more difficult to save. But as they, a lot of people try to play catch up later on, and I think that is important to catch up.
Sure.
But what's important is to understand what kind of income do you really need in retirement, or do you want in retirement? What you have now, a lot of people will be stuck on their gross amount of income that they make, right? So they'll say, hey, I make $100,000 a year at work. Well, they aren't really realizing $100,000 of income, are they? Because taxes are being withheld, maybe 401k contributions, healthcare deductions, all of those kind of additional things. So we want to have a real number as to what to expect. And the earlier they come in, the better.
Okay.
It's super important, if you have a substantial amount of retirement savings and you're younger, you need to really plan. You need to really think about, how much risk do I want to take? And is that risk even necessary?
Yeah.
The risk reward proposition is super important to make sure that, what we've seen is for the last decade is that clients are, investing on their own. And quite honestly, for the last 11 years, a blind chicken could have done well in the market, right? Because it's been this amazing vertical wall where the market's just shot up. But then, like I said earlier, the COVID, reality happened and people said, whoa.
Yeah.
You know what, maybe I need some help here. Maybe, it doesn't make any sense to, do it on my own.
Sure.
And I think that those people that are looking to retire really just need to think about how much risk they're taking. What do is everything in order? Are they being tax efficient? Here's an example. We have clients that, are putting all this money into 401k. And I do like 401k for some people, but the reality is, maybe the 401k Roth at their work makes more sense than the 401k, because deferring taxes to a time, that later on where tax rates might be higher, their tax rates might be higher. Everyone defers all their income to later because they're told, hey, when you retire, your taxes are going to be lower. The reality is that just may not be true.
Yeah, that's true.
Yeah, and part of the service that we offer at our office is tax preparation.
Okay.
But our tax prep office is not about just preparing taxes.
Okay.
It's about tax planning. And so it's really important to understand whether you're being tax efficient or not as well, because if you're efficient, you can take less risk and get the same net result. Sure. At the end of the day.
And Stewart, are you finding that a lot of people do fail to take that into consideration, proper tax planning as they're approaching retirement? Is that number pretty staggering?
It's horrendous what we're seeing from a tax planning perspective. Right, here's an example. Somebody sees a realized income of $40,000 while they're working, or $50,000 when they're working. Some people actually make more money in retirement than they do when they're working. So does it really make sense to defer taxes to when you're retired? Because remember, what people don't think about is that Social Security becomes taxable once you cross certain taxable income thresholds. And there's a lot of strategies we can employ early on that make sense to avoid a lot of that taxation later on. You know, oftentimes couples will receive between $900,000 and $1.3 million over their lifetime in Social Security. Do you want to pay taxes on that, or do you want it tax-free?
Exactly.
Right? And so planning early is really, really important.
Yeah.
You do not have to pay tax on Social Security in all situations. We have clients with several $1 million that don't pay taxes on Social Security because they're very efficient. There's tools like Roth conversion, Roth contribution while you're working that can all help, you know, create a more efficient portfolio and a more efficient structure.
It sounds like you have something to offer everyone that comes in. So let me ask you a question. What does that first consultation feel like for a client coming into the office? Is it about a 30-minute time block, or is it still more Zoom? What are you seeing right now, Stewart?
Well, it's kind of a mix. The nice thing is, you know, our corporate headquarters is in Sun City. We have a satellite office in Scottsdale. We'll soon have an office in Tempe. But you know, it's all about feeling each other out to see whether it's a good fit. I think that's first and foremost the most important thing.
Okay.
We're seeing about half of them on Zoom and half on, you know, in live in person.
Okay.
We're very respectful of people's, you know, concerns about COVID, obviously.
Sure.
But, you know, at our office, we're always masked up. We, you know, are clean freaks when it comes to, you know, making sure that we're disinfecting everything between appointments.
Sure.
You know, we have multiple waiting rooms so that clients don't have to feel completely stuffed together.
Yep. Okay.
But I think it's important to be able to respect the client's you know, feelings about you know, COVID and so forth, which is the main driving issue of whether they come in or do Zoom.
Sure, absolutely. So is it basically like a 30-minute consultation, though, would you say, Stewart, typically? Or
30 to 90 minutes.
30 to 90,
yeah,
typically. Okay.
I usually block off 90 minutes in case somebody talks as long as I do.
Okay.
But, you know, for some people it's brief. It's a quick, hey, you know, this is going to work or it's not. And, you know, they're all different. But, you know,
sure.
An hour is probably about average.
Okay. Well, Stewart, we have less than a minute left to the show. Can you tell the viewing audience what they can expect to receive by being one of your callers today?
Well, if they call in today, we're going to offer that complimentary portfolio analysis to really see where you're at. And that phone number, if you call in, it's 833-652-7829, and we'd love to have them.
Thank you, Stewart. To the viewing audience at home, thank you so much for watching again this week. That number to call once again is 833-652-7829. We never want you to feel like you're entering the retirement years alone, so Stewart is here to help guide you through that process. He'll make it fun, engaging, and stress-free. We appreciate you spending time with us today. We know your time is valuable. Once again, the number to call is 833-652-7829. We will see you next week. Be safe, be healthy, be blessed, and thank you so much for watching.